Happy Thanksgiving. In this episode, Ryan and I discussed the relationship between premium and income and what that means when implementing the infinite banking concept. We had fun. Hope you enjoyed. Thank you. Welcome to the Banking with Life podcast. I'm your host, James Neathery.
And I'm your co-host, Ryan Griggs.
Deep underground, undisclosed location 20 miles south of Fort Worth, Texas, in Alvarado. We're springing forth the idea that you can become your own banker in accordance with Nelson Nash, God rest his soul.
Yeah.
So,
happy recent Thanksgiving.
Yes, happy Thanksgiving.
That was yesterday.
I'm full, right?
You're always full. I don't know. If
You're the one that's always eating. It's like, look, go back and listen to all the episodes. I'm ready to go eat. I'm hungry. Like, and it's like, you know.
That's what happens when you have access to Texas barbecue.
Right. Or goat lock. Eat everything but the good stuff first. All right, what are we talking about today, Mr. Griggs? Things we're thankful for?
Yes, and in fact, I am thankful for this. So there is a phenomenon recently. We like to address things that come up with greater frequency with clients and new clients on the show, so that other people can benefit from those interactions as well. And something that I'm noticing happening. So when this individual wants to become a client with my office, just like with yours, there's an initial process. Right?
You have a process? Have a process?
There is a process, and it involves scheduled calls, and yeah. So there's a whole process, an initial contact.
I mean, I can't just call you and say, hey, I want to buy this much or that much.
And he doesn't, they don't watch the show. So the representatives from the life insurance companies, they just want to call up whenever and have a chat.
They recruit you.
By the way, you're not my customer. So my schedule is not here to fit according to yours.
Well, I have a question. So
They've got so many questions, and there are now so many episodes that they can benefit from watching.
You mean I can go online and listen to 100 hours of legitimate infinite banking concept discussion?
Yeah. And
5,000 hours that are not legitimate.
They ask me, is there anything I can do for you? What would be, I want so badly to tell them the truth to that question.
Are you talking about the insurance company?
Yes.
Representatives?
Yes. I'm like, there absolutely is something you can do. And I've told it to you before. There's a book you can read and there's a podcast you can watch. And then we'll be right up to speed with one another.
Well, I like the ones that, and listen, I'm not beating up anybody individually. The industry in particular, though, you're fair game.
Yeah.
Okay. The life insurance home office, regional staff, representatives, that want to recruit you, and then they're going to talk about the infinite banking concept and not that they don't know anything. I mean, so, it's greater than zero, right? But there's a way of connecting, let's talk about the infinite banking concept, understand that's where you operate, and then start throwing these things around, and I'm just listening and paying attention, and I'm feeding it back to them with questions, and it's then they quit asking all the questions. At the end of the day, if you're a life insurance company, and I tell them all, I'm not promoting you. I'm not promoting you, and you or you or you. I may pay substantial premium, and I do, right, with the companies that we embrace and promote on an individual basis or use to solve the banking equation for someone who wants to become their own banker. But that does not mean I'm going to promote a life insurance company, and neither will you. You get a lot of questions like, James, who are the big four? Company, what's the five? What's the top 10 companies? And blah, 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 blah. No.
Yeah, that's just, it's marketing. It's unpaid marketing for the life insurance companies. And
I already do enough work that's unpaid. I'm an unpaid tax collector, and I'm tired of it, right? I sell books.
As it turns out, the clients are the ones willing to learn.
No question.
So I'd much rather talk to them.
Well, maybe you need a new sales idea.
Oh,
from
shudder. All right. What I'm thankful for is when I do get to talk to clients, which is often, and part of that new process, that becoming a new client, I ask initially based on the research you've done, the reading you've done, the listening and watching you've done, how much premium do you think might be appropriate for you? And it's not set in stone. You know, we're just getting started. We're starting to think numerically in terms of that person's situation. But what I see happen more and more often is that where people think might be the appropriate place to start very quickly transforms into a higher number. And
oh my goodness.
And there's some caveats to say up front, right? This is not about, you know, you should not get the idea that you got to make such and such amount of money per year in order to qualify or be eligible for the infinite banking concept. This is not about the absolute level of your income, right? This is where you're at, where somebody is starting, and how much of the available financial resources, given their circumstances, they are willing to consider for the purposes of accumulating capital and dividend paying whole life. Right? That's the question. And so what I'm noticing is that, and what I'm observing here and pointing out here, is that we see a evolution in people's thinking. And it doesn't always happen, right? Somebody might have a very precise idea of the kind of premium or the kind of money, the kind of financial resources they have available to pay premium. And that may not change, right? So I'm not saying it's necessary. I'm just saying it does happen a lot. And in one particular case, I talk in terms of percentages of income, right? So as a percentage of income, we started out around 5% of the individual's available annual gross income. 5%, use that to pay premium. Well, that number jumped up closer to 25% by the time.
What?
Yeah, by the time all was said and done, we got into an application.
How long was that timeline of all that's said and done? I mean, just
from the time we first started talking to when he got into an application was 2 weeks.
So in 2 weeks, you go from 5 to 25% of gross.
Listen, you have a few phone calls with me, and things are going to change. No, I mean, it's. If you know what's going on, you'll know what to do.
Sure.
That's what it's all about. And the reason I bring this up is because I feel like a lot of times there is still, even for people who have done a lot of research up front, there is the frame isn't exactly perfectly set. And what I mean by that is we still don't have a perfect understanding of how the premium and dividend paying whole life works in terms of the required minimum obligations and the flexibility on the other hand, right? And that's part of the process when someone is approaching me to get a new policy, that we're talking through that. And if you know what's going on, you'll know what to do. The whole point is to just clarify what's going on, properly classify, right? Clarify why, or the way in which premiums work, the way base premium works, the way PUA premium works, which one's required, which one's not, which one has to be paid on a scheduled basis, why we work with companies that allow a lot of freedom to leave a majority of the premium unscheduled so it can be paid at the client's discretion throughout the year when the funds are available.
What?
Yeah. So once we start to nail those things down, and again, a lot of that is individual specific, right? So their need for capital, how much cash value relative to their premium, reverse that. How much illiquidity they're comfortable with early on, right? It's a question of how much, how long they're willing to look out into the future. In other words,
illiquidity. I want whatever I put in. I want a greater number tomorrow.
Yeah. So it's a question of that, their comfort level with illiquidity, which is a function of their understanding of the concept, right? Yep. The better you understand what happens in the long term, the more comfortable you'll be with illiquidity up front. So once we take account of that, we take account of the available financial resources, then we can have a discussion about the structure of that particular policy for that particular person and why we choose the companies we choose in order to place that business, right? In order to get that contract, right? And other things that are never talked about. Right? The big major marketing names are parroted around in order to associate themselves with a perceived position of authority, right? Because you see these companies online, they're really historic, and if you're with them, then you must be authoritative just like they are, right? There's never a question or never a discussion of the functionality or the characteristics or the qualities of the particular contracts and the qualities of the particular features of those contracts, namely the PUA rider, right? And the recognition, treatment, and the policy loans. it doesn't start there, right? It starts top down. Here's the name of the company that you ought to work with, right? Yeah. Because of course, and these so happen to be the features, rather than starting from a philosophy, specifying and articulating why we're doing what we're doing, and then aligning that to the best of what the industry offers in terms of the product features, and letting that sort out the correct company, right? So anyway, we have that conversation. And in doing that,
how many conversations are you having in these studios? I mean, I'm just wondering.
With this gentleman, George, by the way, George watches.
Thanks for listening, George.
Yeah, it was. We had 2 calls, and then reviewed the contract, and then went to the application.
Well, I know that we talk regularly, and a week or so ago, and he has a new dog. Okay, he has a new little Great Dane, Lucy, wonderful little dog. So he's a dog dad, right? And he's taking good care of Lucy, and it requires a substantial amount of time, right? And we spoke a couple of weeks ago, and I think he even had maybe a photo on Facebook. How your jaw had hurt. Your jaw was hurting from being on the phone.
I felt like I had talked my face off
all day long. Yeah. In some of these marathon conversations, apparently, or multiple of them.
Yeah. And on that particular occasion, I spent way too much time with somebody who wasn't really interested in learning, which, my fault. But
there is a lot of that. Okay, so that is all very well said, too. And I must say that's most of the time, I don't care how much research you've done, and the more you do, the better off you are. Right? There's still things you don't know.
Yeah.
Right. So when you engage, when you reach out to my office, his office, and you go, there's additional learning or understanding that you're going to be exposed to. Additional learning, your understanding is going to increase, and really your understanding is going to increase from now on forever. You should never cease learning. But I'm just saying that people really don't know. When we talk about lack of liquidity or illiquidity in the early years, compared to being 100% liquid from the marketing, click funnels out there, you may think that because there's a lack of liquidity, it's going to be terrible, right? And I must say, it's been my experience the whole 16 years that I've been exposed to the infinite banking concept. We all start too small, and it's okay. We all start too small. Why? The mind cannot foresee its own advance. You don't know what you don't know, and the more you know that you don't know.
Yeah.
Right? So my point is, we all start too small. I did, and, it's very easy.
I did.
To overbuild a policy, because of the excitement and the magical, opportunities. And it's also very easy to underbuild a policy. Building a policy so small because your mind's not expanding, or because you don't know what you don't know. And then you're continually having to buy other or multiple policies. And I'm not saying that's a bad thing, but as a matter of path, as a matter of foundational application, you should not start with the idea that I'm going to buy a policy every 4 years, or every 5 years, or every 10 years, or every 7 years, or whatever. All right. And it is difficult, or can be difficult, to build the exact right policy if you don't know what you're doing. But if you do know what you're doing, and you are willing to learn, and you're working with someone who's educated, it's pretty easy to build, the correct size. Even then, you're typically going to start too small, okay? And I'm saying that to say this, that it's a wonderful thing whenever you do your research, you're like, oh my gosh, you vetted it with however you vet decisions for you and your family, and you decide that, yes, I want to become my own banker, and I'm going to start, and I'm going to be bold, and then it's better than you thought. And it is. Then it's easy to expand.
Yeah. You were telling me earlier you've had several people recently where that's been happening.
The last 2 weeks.
Yeah.
It's been, and it's okay to not overbuild and not underbuild. But whenever you start, whenever I started, whenever you first started, too small, even though it was bold.
Yeah.
Right. And then it's like, oh my gosh, no, it really is easier, or it really is better than I thought. It's easy to expand.
Right.
And then, things happen. We always, not always, but we typically, we're surrounded, as like Jim Rohn said, negative is normal. We're surrounded in negativity. We're surrounded in noise. And okay, and that is true. I agree with that. And I try to point it out, and I'm on the, I try to pay attention. But, good things happen too. Good things happen, and good things are going to happen. And you don't know how good they are, and you don't know when. The future is unknown. So it's hard to see. And you can go back at your age now, go back 10 years. Did you ever in your wildest imagination believe or know or have any inkling that you'd be doing what you're doing right now? No. Most men that I talk to in their 20s, they don't think they're going to live to their 50s and 60s. Mm-hmm. And then they do, and then all of those numbers all of a sudden magically matter, your A1C levels, your cholesterol, your waist size, and almost to the person, they didn't think they would be doing as well as they're doing. So I'm just saying negative is normal. It's okay to go big, and it's okay to also be restrained, by a competent, educated agent. Right? It's like, no, that's kind of too big. If you've got to go leverage your home with a HELOC to come up with a premium, it may be too big of a premium.
Maybe.
I'm just saying. Have those conversations. I said it in the past and shared it with you many times that, these big, gargantuan premiums, which is not required to become your own banker. Yeah. Okay? It is not required. And the policies were funded through HELOCs. And after the second or third year, and you have all those outstanding, well, how am I going to pay a premium and an outstanding loan?
Coming cash flow.
I had my share of those.
And that's part of this is why.
Correcting those. I didn't create them.
Right.
Or I didn't help create them.
This is why we can only get so specific. What's the perfect structure? What's the perfect company? How exactly do I do this? Those questions cannot, should not, will not be answered on a forum like this. It has to be discussed one-on-one. If there are people out there who are giving you those answers, you should be skeptical. There are certain things that can only be addressed one-on-one, right? And talking through the optimal way to go about this, you mentioned not underbuilding, not overbuilding. You should have, ideally, if we could predict the future with certainty, we knew exactly what your income experience, your expense experience was going to be like over the course of your lifetime. If we knew exactly how much premium you would end up wanting the ability to pay over the course of your lifetime, we could put together a plan for a number of policies to accommodate that income as it rose over the course of your lifetime. And we'd get it exactly right. But we're not God, and we can't predict the future. We don't know exactly what's going to happen, and we can only look so far ahead with a reasonable degree of confidence, right? And so if we want policies into which we can pay as much premium because we want to build as much capital, we want to build as much cash value as possible, we have to have a conversation about what that income and expense cash flow picture looks like, right? And that's a very specialized kind of conversation. And I have never once met a person for whom it did not feel uncomfortable at first, right? Because it's different. It's learning to think like a banker. It's talking about the timing and the dependability, the degree of confidence and future cash flows, both incoming and outgoing, and developing an understanding of the degree of control and the time over which you have that control, right? There is no way to have that discussion in terms of your financial circumstances without first knowing you and without first having the conversation that we need to have to even get to that point, right? Because we've got to understand the differences in premium. We got to understand what's going on in a dividend paying whole life contract and why, right? There's a lot of ground to cover first.
Well, listen, I'm not going to read a book, so just, give me a 15-minute phone call.
You're just not a good candidate to be independently financially wealthy. That's just, if you're not willing to rethink it goes back to everything goes back to what Nelson taught. If you're not willing to rethink your thinking, okay, there are people out there who will
take advantage of that.
Yeah, and they're happy to.
And they'll get paid doing it.
So I'm not interested. But for people who are willing to take that perspective, when IBC is more caught than taught, you hear about the light bulb moments. It finally dawned on me. It clicked. All of these ways of expressing how clarity is manifested in your mind. When that happens, and then you see it applied in your own financial circumstances, it's just, it's off to the races.
That reminds me, and I've said it many times before, but I'm appreciative to have the opportunity to say it again over and over and over. It's my story. I like sharing it. It reminds me, right? Probably 4 years into practicing the infinite banking concept, I met Nelson because I was exposed to his book, and then I ordered some books, and he answered the phone, and I'm very thankful for meeting Nelson Nash, right?
Me too. I'm thankful you met him too.
Right. And I'm thankful for the opportunity to spend the amount of time that I was able to spend with him. But I'm 4 years into practicing the infinite banking concept. I bought big old life insurance premiums as soon as I flew home from the first time of listening to Nelson, and restructured all of ours. Never paid that much before in life insurance premium. Yeah. I'm just like, and then it's paltry. It's pennies compared to what I pay now. It's unbelievable. And I'm so thankful. And no way could I have looked 16 years into the future and said, oh, you're going to be paying this much in premium, and you would have done this, and this. And angered many bankers and educated several. Which I get no joy out of angering bankers. That's not true. Okay. I'm shaving. It's like literally I was outside the hospice facility that my father was in. Mm-hmm. And it happened to be in April, and taxes were due. Right? And so I had to, write Uncle Guido a check that could choke a mule. Mm-hmm. And it dawned on me after 4 years of practicing the infinite banking concept, buying life insurance, right, using the cash values to finance, at that time, no credit cards, automobiles, education, and whatever, right? I mean, I was doing it, and I still do it to this day. And I could tell stories. I'm just saying, it dawned on me. I'm writing this check to Uncle Guido, and it should have been a life insurance premium first. And I relate it to, it's like a man shaving every day in the mirror, and 4 years later saying, oh my gosh, that's a nose. You're looking right, it's right there. Mm-hmm. I mean, it's just, talk about an aha moment or a light bulb, and it's not just one light bulb moment. Right. It's not just one leveling up in knowledge or experience. It's continual, which it should be. All of life should be that way. This is no different. It's not like in the financial world, oh, just put your money in here and it's going to go one way, and then, accumulate it and then decumulate it over your retirement, blah, 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 blah. It's how convenient for the financial industry to say, hey, you abdicate your responsibility, your thinking, your activity, your due diligence to us, and we'll just set it and forget it, and you just go live a happy life. I mean, oh my gosh, talk about top-down thinking. That is completely top-down thinking. This is bottom-up. That's what angers the life insurance companies and all the financial gurus. They didn't come up with this idea to become your own banker. Yeah. Part of it, right? Some old Southern gentleman from Birmingham, Alabama did it. Yep. It angers them, I think. And listen, I know. I don't know all of them, but the ones I've met. I mean, how can a life insurance industry exist in the U.S., right, for over 100 years, and this idea of becoming your own banker is all of a sudden shocking or a new revelation to a life insurance agent or a life insurance company?
But it is, and it has been.
Oh my gosh!
Even when Solomon Huebner was talking about it in the early 1900s,
the communist professor,
the idea that you could take a policy loan. First of all, the idea of a policy loan was like, oh, you should never, this is the last thing you should do. And if it was talked about, it was talked about only in like the static singular sense, right? If you have to, you take this one loan this one time. Let's go repay a loan, take another one.
I want to touch on that for a minute, because previously, historically, and I don't even want to say previous, that's not the correct use, right? Historically, an outstanding loan on a life insurance policy, right, is a precursor to a lapse or a surrender of a policy. So the life insurance industry, yes, of course, everybody knows or understands if there is a cash value or an account value and there's a loan provision in the life insurance contract, that cash value is subject to loans.
Yeah.
Everybody knows that, right? Everybody's had an uncle or brother or whomever that was a life insurance agent, right? Dave Ramsey. I don't want to edit his name, whatever. The financial guru, talking head that says, well, you're going to borrow your own money. They're going to charge you interest to borrow your own money, and all those fallacious statements. Okay. Everybody in the life insurance industry, home offices, historically has looked at outstanding loans as a precursor to a lapse or a surrender.
Yeah. The fear is if you got to borrow money to pay a premium, you must be threadbare close to not being able to pay a premium at all.
Exactly. And so they don't like it. Right? Okay.
Even though it's perfectly collateralized, and if it's priced properly, the lapses should have been taken into account well. Maybe if they gave better agents contracts and didn't give contracts to unscrupulous ones. And
let me add to that, too. You go back further. The first loan provision was expressly put into a life insurance policy so the owner could borrow against the cash value to pay a premium.
Right. Premium financing is the origin of the idea.
Oh, my gosh. They did it for them. Right, the life insurance company, put the loan provision into the contract so the owner could borrow against the cash value to pay a premium.
Even in the very early years. It was like a sales pitch. Like, you can get this much death benefit. This is what the premium would be. Oh, but we'll let you borrow some money to pay the premium up front, right? And then it's like deferred payments on a new car loan. You know, no payments for 90 days, no payments for a year to start paying your premium next year. And the industry wonders why it's had such a troubled regulatory history.
Oh, because they earned every black eye that they get. But then it's like, it's okay for you to borrow money to pay them, but you don't go borrow money to finance major purchases from them. I mean, oh my gosh. So what's new in the financial industry?
Right.
Not much.
And so one thing I wanted to add to that earlier acknowledgement, that as people go through the process and they start to see what's going on and why and how it applies to their life, you know, the horizons broaden. They start to see what can be done and how much they want to start with increases. But then you add something to that I've started to share with people as well, is that over the course of your lifetime, there is a relationship between the level of income that you're earning, let's say on an annual basis, and the proportion of it that should go to premium. And I think it's the correct way to frame a lot of this stuff, because you've got, in becoming your own banker, there's a discussion about premium equaling income, and people are grappling with the idea of, you know, can I do that now? Is that even possible now? Do I do it eventually? And, you know, it's again, we're kind of in a frameless territory where we don't really know the context. And so I think this dynamic, like explicating and articulating this specific dynamic is helpful. It's like, look, you're going to start wherever you start. Your financial circumstances are what they are, right? You have a certain amount of income, you have a certain amount of financial value, capital built up in other assets. You're going to want to use a certain percentage of that income to pay premium, and maybe you want to use a certain percentage of value accumulated in other assets to pay premium as well, right? Whatever that looks like, it is what it is. And when we have a discussion about what's going on in the contract, you'll know exactly how much it is of those two sources, your ongoing cash flow and the value you can get to today. You'll understand how much of that you want to use to pay a premium. And we'll talk about the way to talk to the accountant to get it done on a tax efficient basis. And then time's going to go on, right? You're going to get older. You're going to continue to earn. You're going to continue to do what you do, right?
Unless you die, unless you graduate, right? And then your people are left with an income tax-free death benefit.
Yep. But in general, for the most people, on average, the income's going to rise, right? Your ability to pay premium is going to rise. And as your income rises, a larger and larger percentage of that income should be going to premium.
Honest banking.
And eventually, that percentage of your income going to premium in a given year will exceed 100% of your income.
What?
It's going to happen at some point in time.
What?
Yeah. Either the income's going to begin to decrease on an annual basis, or the dividends in policies that you own, where the dividend, as it should, is going back into the contract in the form of PUA premium. Those dividends are going to get so big that they'll eventually exceed what will be a declining annual income. Now, theoretically, could you outlive that trajectory? Could you do so well in terms of income generation, even in your later years, that even then, these policies that you've owned for 20, 30, 40, 50 years don't pay dividends that are high enough to meet your income? Could that happen? Sure. And that's a good problem to have.
Yeah,
but for
still,
most people, that's not going to happen.
Yeah, no, you're exactly right, too. And then, look, if I have a premium, that's an illustrated premium or an actual premium that's being paid, those dividends eventually are going to
dwarf
the premium.
Yeah.
Right. Just by default on a properly structured policy, right, and properly used policy. I know, Nelson would never, and I've been corrected by David, his son-in-law, David Stearns. He runs the IBC NNI board member. I've referenced, Nelson's 10-hour seminar many times, right? And there's available a 20% discount code if you want to contact our office to purchase the 3 DVD set series of Nelson's seminar. And so the correction is, I've been saying 9-hour, 8-hour, 10-hour seminar, and I was informed and corrected by David that it's 6.5 hours.
Right.
All right. And he's like, well, just say it's a 3 DVD set. Okay, so I've said it. It's a 6.5 hour series, and it's a 3 DVD set. But my question to him was, David, and we're friends, we speak regularly, what'd you do with all the other time? I mean, why'd you shorten it? All right, because we've hosted Nelson in North Texas and around Texas, for many years, 1 to 3 times a year. So I heard the man deliver his 10-hour seminar many times. Mm-hmm. So I'm like, David, what'd you take out? And he took out all the incidental antidotes and a lot of quote-unquote rabbit chasing, going down different holes. Nelson used lots of analogies and lots of experience. And and then when he traveled, he'd always have a slideshow of the places that, him and Mary had traveled to. And so the live event was much more than just 6.5 hours of Nelson going through this book. However, I'm saying that he used his 1959 State Farm policy in his presentation, as lots of different examples. And he used the dividend to reduce the premium in the first 15 years of that policy. So there's lots of dividend elections that the owner has a right to choose between, the best one being the dividends paid to the PUA. But even the 1959 policy that was, the dividend was used to offset the premium, that
go back into the contract.
Those dividends dwarfed his premium unbelievably. Mm-hmm. And if he hadn't offset the premium with the dividend, it would have been, 2.5-fold. Right. All right. Well, thanks for letting me share that. It relates 6.5 hour DVD series.
It relates a lot to the next point I wanted to make. So we talked about how there's a development in thinking pre-application, right, for a new policy. Right, we're starting to learn more, starting to see what's going on, how it applies to you, the percentage of your the percentage of your available financial resources, including your income that you want to devote to premium, is going to rise right then, right? And then you add this the dynamic element where over the course of your lifetime, as income goes up, the percentage of that income that's devoted to premium should rise. And one of the nice benefits will be that as you diligently practice the infinite banking concept over time, exactly how you said, the dividends are going to dwarf the premium that you pay into those contracts, as Nelson showed. And by the way, those checks are reproduced in Building Your Warehouse of Wealth, second book. So for the people who ask for examples, there it is, right?
And he's referencing the premium that Nelson paid over the life of that policy. And I guess it was, I don't know how many years ago it was. I know he did it for 4 years. But what he did, there came a point in time where the company sent him a letter wanting to confirm his social security number, right? because he
was about to reach his cost basis.
Yeah, he surpassed his cost basis, right? And so he said, "Oh no. You send me a check, right?" So let me get it right. So he told the company for the purpose of for the purpose of reproducing those checks, he wanted to be able to reproduce those checks and make his point in his presentation.
But the dividends were as big as he was saying they were.
Right, and the policy's doing what it's doing just by design, just by its mere existence. So he told the company to send me a check, right? So send me the dividend check. So he took a dividend check for 4 years, and then the company sent him a letter saying, "Hey, we want to confirm that we have your correct Social Security number," because he received all of his basis in those 4 years.
Right.
And then he told them, "No, thank you. You're not sending me a taxable check. You have the dividend get paid back to the PUA."
He changed his dividend election.
Right. And he said, "I have no money in that policy." Right.
He had received back everything he had paid in.
Everything that he had paid in. I mean, think about that.
Yeah.
And then anyway.
This goes exactly to where I was headed with this. Okay. At some point, just like Nelson did, you reach a break-even year, right? You reach a cash-on-cash year.
At some point in the future.
At some point, for everybody who's practicing infinite banking with the correctly designed policy that's been well-funded, you're going to reach a point where the net cash value exceeds your cost basis, exceeds your cumulative premium, how much premium you've paid in since day one, okay? That's going to happen. The cash value as a percentage of your cost basis or as a percentage of your cumulative premium will reach 100 at some point. And after that point, it's an inflection point. After that year, after that break-even year, that cash-on-cash year, the cash value as a percentage of your total premium since day one will be greater than 100. And so I like how you put it. Do you want, and I put it to George, who I had mentioned previously on a recent episode, that do you want that cash value as a percentage of your cost basis? Do you want that percentage to be 100% of a small number or 100% of a big number? He's like, a big number.
Yeah, that's a fair way to interpret that. So, yeah. But okay, so
but
why?
Does that make sense? That's like,
yeah.
How big do you want that number to be?
Well, listen, I want the cash value to be extremely big. So can't we make that happen in 6 months? Can't we make that inflection point happen tomorrow? Look, if I go
not without sacrificing certain elements, right? Once we're set
several very important elements.
Once we're set on the philosophy, once we have the appropriate long-term perspective, once the policy is built correctly to be robust to future financial fluctuations, should you need to reduce your premium, once it's built to allow you to pay a premium for as long as what we have available in the industry that would allow you to do that, once that's decided, once that's determined, and we're now discussing the appropriate level of premium, it's okay. How do we want that cash value as a percentage of cumulative premium to be big or small?
Yeah, and let me. I'm going to add to that because we talk very often, and we've had discussions previously several times where it's almost like we feel like we have to talk in code sometimes, not intentionally, but we don't want to mention names. I don't want to mention individual names other than George. I don't want to mention life insurance companies. I don't want to promote life insurance companies. And I don't want to call anyone out in particular or individually or by name and what have you. But listen, the cash value of life insurance, of a whole life insurance policy, is going to equal the face amount at maturity, which is 121 years today. Right, the actuarial, theoretical life expectancy of an individual insured is 120 years. So all life insurance is built upon that basis, 120-year theoretical life expectancy. The cash value will equal the face amount at age 120, period. And my question is, do you want a large death benefit? Do you want a large face amount at age 120 or a small face amount at age 120? It's a straight yes, no, big, small answer. Of course, we want it large. Now, am I going to sacrifice all of the cash value between now and then? No. right? No, I'm not. Okay. So I want to continue. That cash value is not guaranteed to grow at 4% annually to meet the future death benefit at age 120. Yeah. I'm just saying, I want to bring some clarity. The cash value is going to increase no matter what you do, as long as you pay a premium. You're with a legitimate mutual life insurance company that pays a dividend, all right? And the policy, no matter how it's structured, if you have zero cash value for the first 18 years, that cash value is going to equal the death benefit at age 120 by design. Okay. And I just want to wrap it up here on this point that the cash value is going to accumulate and grow every year. At what year does it cross over total premium equal total cash values? At some point in the future. And we want that to happen as soon as possible without jeopardizing the integrity of the policy. It does no good for me to make sure that I go cash on cash in a particular short-sighted year if I'm going to sacrifice that policy in the 25th or the 30th year. I mean, why would I want to pay substantial premium in a tax-deferred vehicle that is accessible tax-free and then pay a honking tax liability or experience a honking tax liability 30 years from now? I mean, it makes no sense.
Yeah.
Okay. So my point is, do your research, keep reading, read Nelson's book, Becoming Your Own Banker, read his second book, Building Your Warehouse of Wealth, watch the Banking with Life DVD. And I understand it's 2020. Your children have game boxes. You can still stick a piece of plastic in there and watch that. Whatever.
What is a game box?
I don't know. It's like, isn't there a new one coming out?
That's hilarious, a game box.
What do you call them?
Well, there's the
Don't act like you're not a gamer.
PlayStation.
Oh, okay. Did anybody misunderstand what I've said when I
game box? It reminds me of the GameCube. Some people might remember that. It's a console called the GameCube.
Yeah. Okay.
That's hilarious.
And then wait. I'm not finished self-promoting, but I'm promoting the Nelson Nash Institute. That's where you get the DVD. That's where you get his books. His 6.5 hour live seminar is the DVD that I'm speaking of. The Banking with Live DVD is a separate. So there's Nelson's 6.5 hour seminar. Then the Banking with Live DVD that's about 52 minutes. But then on this channel, watch the book review that Ryan and I did on Becoming Your Own Banker, the book. That review. It's on audio. It's not meant to replace the book, but listen to that. And I'm saying that to say this because I see over and over and over, I get stalked, you get stalked. If you search the infinite banking concept on YouTube or Google, you get stalked. Even on Facebook with all of these, programs for $3.95, $2.95, $4.95, $99.99, $99.95, whatever, to go through somebody's program, boot camp, whatever they call it. And I'm just saying, if you want a proper education, go to the source. Go to the Nelson Nash Institute. And you can do it affordably. That's my whole point.
Yeah. Okay. I would just add that that's where you start. It might not be where you stay, but I'll add this too, that so often when we're trying to understand, we look for a frame, we look for a point of reference, and we hear death benefit. So often it's presented online that it's in life insurance that's about death benefit or cash value, and that's why we come back to this. That's why I wanted to present that trajectory of, based on my experience with this particular client, George, this past weekend, about how the understanding developed. And as the understanding developed, as we adopted the correct frame, and by that I mean it's not an either or. It's not a cash value or death benefit. In fact, the only reason you have cash value is because there's a death benefit. When you generate early cash value with PUA premium payments in the early years or at any point in time throughout the course of the contract, the only reason those PUA premiums are generating cash value is because it's buying more death benefit, right? The cash value is the net present value of the death benefit. And I know those are like mathematical or actuarial words, but if we can wrap our arms around that, everything else becomes clear. If I can directly through my own action increase the magnitude, if I have the contractual right to increase the magnitude of that future cash flow by, in other words, adding more death benefit, then I also therefore have the contractual right to increase the net present value of that future death benefit. And if I can do that, then I'm increasing my equity. I'm increasing the capital.
If you do one, you're doing the other.
You're doing both.
You know, it's not like I'm going to increase the death benefit and not increase capital. You're doing both.
Yeah, you can't. It's impossible to get one without the other, right? And so, and that's so vital, and that's why I like the way that you put it. It's like the cash value, because the cash value is the net present value of the death benefit. Therefore, when that death benefit pays, when the net present value obtains, when it equals the future value, right? When we get to that point where that death benefits paid, in the case of life insurance, at the end of age 120, the start of age 121, do you want that number to be big or small? It's like that. It's that simple.
I'm not going to need any capital if I live to age 120. My children, my grandchildren, my great-grandchildren, they're not going to need any capital. Uncle Guido will have weaned himself from his need of my capital, so there won't be any taxes. And it's like,
you've just got a misunderstanding of economics. You're not, if that's the, I'm not going to need that money in the future. First of all, you should be nicer to yourself. Okay. It's okay to have access to more capital in your later years. Right. And, there's also been the idea out there that I'm spending everything I have. I'm not leaving my kids anything. We need to take that idea, put it on the shelf, and then leave the room and lock the door. Okay, there's nothing helpful about that.
Where are they going?
It's not either or. Where it comes from is like,
no, I don't.
They're only going to get it if I don't spend it, and that, again, very static capital liquidation style thinking. If we're thinking like a banker and we're thinking in terms of accumulating capital, the only way in life insurance to accumulate capital is to increase how much your kids or your people get. Right? The only way to increase how much cash value you have available to you to use for what you want is if you increase the magnitude of that future cash flow. If you increase the death benefit. You can't help but benefit other people, right, by pursuing your own interest.
Oh my gosh, that's the foundation of economics. Boom.
So if you adopt that, it's like what the question becomes, and we go through this with people, we start talking about, having a conversation about how to think about available financial resources in order to determine the correct level of premium. And sometimes, not with everybody, and whether it's in the first policy purchase or whether it's the next one, eventually it's not how much premium do I want to pay, it's how much premium will the company allow me to pay. It
always gets to that. Nelson said it too. When you solve for your need for finance, you will be asking for so much death benefit that you cannot get it past the underwriters. And let me tell you, that's I like to think we make it look easy. It's like a duck swimming across a lake. Everything's calm, cool, and collected above water. Underneath, they're paddling like hell. I mean, that's a daily struggle, is getting what we want past the underwriter. Because, and I see it in the industry, there's all kinds of shenanigans that go on. We don't operate in that world. We're all very straightforward. These are legitimate, structured policies. We're not withholding things from the underwriter because they're bad guys and they don't want to issue policies.
Clear.
Yeah. So when it's clear and you're straightforward, whenever you really get to the point where you can solve for your need for finance, the underwriter, you cannot get it past the underwriter. It requires so much death benefit that they can't legally issue it.
Yeah.
Anyway,
you have to, life insurance, I've said it before.
The struggle is real is my point, okay? The struggle is real. We make it look easy, and we have great relationships with underwriters.
Yeah, so. Yeah, I'm going through that right now with a couple of clients. But the life insurance is the only asset where your ability to pay does not determine how much you can buy, right? They limit it according to your human life value, which is a problem, but it is what it is. And so we got to deal with that. And here's another tweak on this. For the agents and advisors who are contorting the structure of policies, what they're doing is let's put it this way. When you think long range and you get a contract built the kind of way that we would build them for people, an individual's accumulation of death benefit will happen in a proper fashion over the course of their lifetime.
An appropriate
time, right? What happens with people that, in order to get the 1090 or the 90/10 or however you want to call it,
85/15. Listen,
you've got to buy more and more death benefit earlier, and as you've put it, you eat up the insurability.
That's only one issue. So you're going to cause that lack of ability to get past the underwriter sooner. Whenever you contort the policies, and I choose my words carefully when I use the terminology, jeopardize the integrity, properly structured, Frankenstein policies. Those are not incidental, accidental. That is on purpose. Whenever you have the short-sightedness to contort a policy, right, to make these illegitimate liquidity happen sooner, right, you're sacrificing. That's just one thing in the unknown future that you're sacrificing is your insurability.
Limiting.
Oh my gosh.
Limiting your ability to pay a premium in the future.
And so whenever we're solving for our need for banking and finance, we're going to get to that point naturally that we have used up all of our insurability. You're just accelerating that when you contort these policies. And then let me say too, in addition, look, there is a proper way to expand your banking system, quote unquote, right? There is a proper way to do that. So what? You use up all your insurability. Perfect. Who's next? Right? And I'm not saying that lightly, right? If there's not insurable interest, you're not getting a policy anywhere. I mean, there's a proper way to expand your system, right? I don't care who you are. And it's not looking for your first business partner available. Not that you can't do that, okay? I mean, I don't want to belabor the points there.
No, that's I don't think we've talked about that before though, because it's a fairly sophisticated consequence.
I have purposely not talked about all of the things that destroys, right? Because several reasons why I haven't spoken to them directly to the big wide world. My clients, I go through every one of them with our clients because they're exposed to the noise. And we're all exposed to the noise in the infinite banking footprint.
Well, that's what I'm saying. It's okay to say it here. Like that's one of the things that will happen. If it is the case that you want to diligently practice the concept over the course of your lifetime, which is, I'm assuming, right, that if that is what you want to do, in addition to inhibiting, put it this way, by advancing the accumulation of death benefit earlier in your lifetime, you're reducing your ability to pay a premium in the future. Those contracts you get right away, the 1090, 2080 kind of things, you're not going to be able to pay the same substantial degree of PUA premium into them in the early years as you will in the later years. I'm sorry, reverse that. You're not going to be able to pay that high degree of premium in the later years as you are in the early years, right? So the contracts you're able to get will themselves accept less premium. But the death benefit's already been purchased.
By construct.
Right. And so as you get older and as you realize the contracts you have will no longer accept the kind of premium you want to pay, and so you want to replace the premium that you formerly were able to pay, and time has gone on and your income's gone on, but you're older, and therefore the multiple that you can apply to determine your human life value has gone down, you will discover. And this is what's going to happen because of the timing of all this.
Listen,
right?
It happens quickly with these contorted policies to young people.
Yeah. Because the income doesn't rise fast enough, or they get older and they drop into the next lower age bracket, you're just not going to be able to pay the kind of premium that you wanted to pay.
Well, it's okay. I don't need to pay a premium later anyway. This idea that premium offset or pay forward no more, pay for 5 years.
I only want to be a capitalist for 5 years, and then
So, sorry for the interruption there. Had a little technical issue. Not enough electrolytes. But you were talking about how the ability to pay a high premium, PUA premium in the latter years is not there. Mm-hmm. Right, and the death benefit has already been purchased. And I want to say that the death benefit will go down. All right. So even the idea, you dang near have to use a blended PUA to get to that construct, and that whole idea of a blended PUA, and why wouldn't the insurance companies create that, right? Of course, because it's on the idea of decreasing term, that idea if you have an increasing cash value and an increasing permanent death benefit, then you can use a decreasing term. Oh my gosh, how old is that idea? And the blended PUA is just the latest version of that, right? So at time of natural mortality, you'll have less death benefit. Well, who does that benefit? The company that issued it. So buy all of that you want, and buy it from a company that I own as well, because we're using mutual companies.
Be a very profitable
and I'm the owner, part owner of that mutual company, and you're increasing the profitability of that company, which is going to accrue to me in the form of dividends. Thank you. Okay, and then too, let me say, of course, we want to be a capitalist our whole lifetime. But I want to say this, a legitimate question, because I'm exposed to the noise too, can't get away from it quick enough, can't get it off of you. It tracks me like it tracks you, and, avoid it like, political news or any news.
Yeah.
If 90-10 is good, if 85-15 is good, if 80-20 is good, or whatever variation, if that percentage of premium to the PUA should be the highest, why wouldn't you buy 97% PUA and a 3% base premium policy? Why wouldn't you do that? Oh, and it can be done. So these promoters of 90-10 are just not, they're being less than honest when they say, oh, you can't do this or you can't do that. No, you can. With some companies do that. So if 90's good, 97 must be better, right?
Yeah. As you start to go into all of the consequences and trade-offs, and my experience has been, as we start to, and people might have some of these questions in the initial.
We were all triggered up there until that technical difficulty.
That's okay. When people have some of these questions, and oftentimes they've watched so much of this podcast, they don't have the questions anymore. They've been answered. But
yeah, sure.
But if they have them when we're going through, eventually they get so sick of it. It's like, okay, yeah, forget about it. We'll just and I mean, everybody has their process, but in my opinion, the sooner the better.
Get sick of it, the sooner the better?
Yeah, it's like.
I mean, yeah, I'm like, oh my gosh, it's like everybody knows that.
It's okay to quit cold turkey. Speaking of Thanksgiving, no pun intended. Right?
That's the best way to do it, right?
And it all goes back to what Nelson taught. And if you want to do what Nelson taught, then you should adopt his philosophy. And it's not short-sighted. We're thinking long range. We're not afraid to capitalize. Being not afraid to capitalize means comfortable with illiquidity. That's what that means. Right? To properly capitalize, to acquire a contract where we can capitalize maximally over the course of our lifetime, there's going to be illiquidity up front. That's it. And that's part of it.
In the latter years, there is no illiquidity.
Right.
And not that far into the future. When I say latter, I'm not talking about when you're 90 years of age or 70 or 80 or, 20 years down the road.
And this now is the correct time to accommodate that early illiquidity.
Which is right? now as in always, right now.
Right now. So that later on, over the course of your lifetime, as we discussed earlier, as the cash value approaches the eventual death benefit at 121, after you cross that break-even year, whenever it happens to happen in your circumstances, you can enjoy the excess, the surplus, the greater and greater cash value over and above what you've paid in.
Which is just the natural result of life insurance.
It's just it's just by design. Don't care what the Fed's doing. Don't care what the market's doing. There was a lot of price inflation from when Nelson was paying his policy or his premium into that State Farm policy in the 50s and 60s, right? And up until in the 90s and the 2000s when he was talking about it.
What?
Right? Now, do you think that because there was all that price inflation, he was upset about the fact that there was a multiple of his premium and annual cash value appreciation in it?
Well, no, wait a minute. He paid a fixed premium, right? And the purchasing power of his premium dollar was declining.
Right.
Right. And I forget what his premium was.
Depreciating currency.
$300 a year, something like that. And I know, yes, I've read the book, and I have the book. And even have the illustrations of his 1959 policy. So, okay. The same thing is happening to us as we speak, right? The value of the dollar is declining just by its mere existence. Mm-hmm. So he was paying with depreciating dollars, right? And his cash value was appreciating at an accelerated rate comparatively. Unbelievable. I mean, it's like an exponential curve up and an exponential curve down. And he didn't have to do a dang thing but pay the premium. And let me say, these policies are designed to pay a premium. So the idea that you have to get everything out as soon as possible because that's a bad place to put money. And number one, think long range. Number two, don't be afraid to capitalize. Don't be afraid to pay a premium, right? Okay. If you have to get everything out as soon as possible, you're not thinking long range and you are afraid to pay a premium. And just because Nelson and Equipment Finance illustrated 4 years worth of premium payments, and then, that creates this whole thought process from the financial world, these wannabe practitioners, we should start another policy in year 5. And we should do it again in year 9. And we should do it again in year 15. It's like, no. You want to pay a premium as long as possible. These policies are designed to pay a premium. Now, does that mean that, I've got to look at 40 years of premium payments in the future? You're telling me to get my thinking up, Mr. Griggs, and start today, right, as soon as possible. Yeah, you should work with a competent agent and use legitimate numbers. If we're talking about your money and it's good, do you want to think small? Or do you want to think big? Do you want to be positive in a negative world? Yes, you can, and it's okay to do that. So I want to think big. I want to come up with a premium so large, it makes sweat beads break out on my forehead. I want my wife to question my intelligence. Not that it only takes a large premium. Let me tell you what, and we've done an episode, my wife and I, my lovely wife, Jen, and I did a Valentine's Day episode, I think, last year. And I discussed it. We discussed it. It was true. About the 4th or 5th policy we were buying, she legitimately and seriously asked, where are we going to get that premium? Where are we going to get the money to pay that premium? And I legitimately said, I don't know. And I didn't. And I thought she was going to throat punch me. She was angry, So I'm just saying, don't be afraid to capitalize. Don't be afraid to pay a big premium. But okay, now once you are working with somebody that's intelligent, competent, educated, and has your best interest. I'm not saying they're not going to make a commission or earn an income, and you want them to, because 10 years from now, when you call their office, you want somebody to answer the phone, right? Well, it costs money to be in business.
Yeah.
Profits are good if we're all so I digress a little. My point is, don't be afraid to pay a premium. Don't be afraid to pay a big premium. And, to the point where I don't want your wife to throat punch you. I don't. Okay. So you can back off of it and start too small. It's okay.
Yeah, it's okay.
And add on, right? And increase. So pay a premium.
Amen. It's always a good day to pay a premium.
All right. All right, so listen, this is, what else are you thankful for on this
thankful
day
for
after
my little Great Dane puppy,
Lucy.
Thankful for you.
Oh,
thankful
thank
for
you.
Nelson.
Oh, yeah.
For the business, for the clients, for the listeners, the viewers. Thankful for a majority of the people who comment.
I'm thankful for in the last episode, the Halloween, the spooky comment episode. It didn't mean to. It's just the way it happened. Printed out some comments from mainly one individual. It was fun. We didn't.
If people want to go on a tear, first of all, they're not going to be released. And second of all, it just gives us something to talk about.
Right. But don't be afraid to comment.
Well, then the people, you see the ones that are released. I mean, it's a nice, positive environment down there, That's as it should be.
Right.
So, yeah.
Well, perfect. Well, I'm thankful as well. I'm thankful for the freedom that we do have, what's left of it in the United States. I'm thankful for the opportunity to practice what is, a close resemblance to capitalism. It's like we do not have free markets, but we have the next best thing or the closest thing to that. And I'm very thankful for that. I'm very thankful for meeting Nelson. I mean, it changed my life personally. He did. And his work, it changed a lot of our clients' lives. And then their future prodigy, even our future prodigy. I mean, it's like I'm so thankful. And I'm thankful for the opportunity to have the ability to convey or promote the idea of becoming your own banker. Not that I live in fear, but I am concerned that, just as healthcare has been nationalized and taken over by Uncle Guido, the entity, the state that does not have the ability to restrain itself, okay, will eventually take over the quote-unquote financial industry as well, and they'll nationalize the financial industry. Look around the world. Some of the great mutual companies of old in the UK and England don't exist anymore. They've been demutualized. And I say that. They, were forced to, okay? And I think that is potentially going to happen here, that Uncle Guido, like I said, is going to nationalize a financial institute. But until that happens, right? Until that happens, you have the opportunity to become your own banker, and I'm thankful for that. And I'm thankful for the ability to engage with people that want something better, right? That want to embrace and empower themselves and their families, and want to disconnect from the lies that we're all surrounded in from the financial world. So I can go on and on. I'm very thankful. I'm a humble, thankful person. And I appreciate you, and I thank you for listening.
See y'all.
All right. Have a great day.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.